Good afternoon. We're a few minutes past the hour, so we thought we'd get started. I'm Bill Gale. I'd like to welcome you to the Brookings Institution and this Tax Policy Center event. We begin by asking the eternal question, how is this event different from all other events? In all other events, we talk about U.S. tax policy and what it means for the country. In this event, we'll be talking about tax policy in other countries and, of course, what it means for the United States. Also, this event is the first annual Donald C. Lubick Symposium at the Tax Policy Center. And I wanted to say a few words about that. We are honored to have Don in attendance this afternoon here. My glasses are for reading, so forgive me that. Don is here with his wife Susan, his daughters Caroline and Lisa, Lisa's husband David. Don also has a son, Jonathan, and many grandchildren. So among Don's many attributes is he's helped solve the Social Security problem. We organized this symposium series in honor of Don and his many contributions to public policy. Don was tax legislative counsel in the Treasury in the Kennedy and Johnson administrations. He was Assistant Secretary for Tax Policy in the Carter administration, and then and again in the 1990s in the Clinton administration. He headed the tax advisory program for Central and Eastern Europe and the former Soviet Union from 1994 to 1996, which could not have been an easy job. He served on the transition team in the Obama administration in 2008. In recognition of all these successes, Don received Treasury's Exceptional Service Award in 1964, the Alexander Hamilton Award in 1980, and the Treasury Medal in 1999. You kind of get the sense that they started making up titles to give to him for his unselfish dedication to public service spanning 4 decades. These are big awards. For those of you who are not tax cognoscenti, these are big deals, and they speak very highly of Don's abilities and savvy and determination. When he was not in the federal government, Don was a managing partner with the Buffalo-based law firm of, let me inhale here, Hodgson, Russ, Andrews, Wood, and Goodyear. He was a senior fellow at Harvard Law School's International Tax Program. He co-authored a volume which is what I think has the greatest title in all of public finance, Basic World Tax Code and Commentary, a template for tax reformers around the world. He advised the city of Buffalo and the state of New York, among others, on tax policy matters. He has chaired the American Bar Association's Committee on Domestic Relation Tax Issues. That sounds like fun. He's taught at the University of Buffalo and American University. He is a graduate of the University of Buffalo and Harvard Law School, a member of Phi Beta Kappa. He served in the U.S. Air Force. On top of that, let me add that Don is one of the nicest people you will ever meet. So Don, we congratulate you on your extraordinary record. Speaking on behalf of Len Berman and the entire Tax Policy Center, let me say we are honored to establish the Donald C. Lubick Symposium in your honor. All right, thank you. Today is the first such symposium. Before I turn to the substance, I want to note these events don't just happen. They require the dedication and patience of savvy of many people to set them up. I want to thank 2 people in particular, Blake Green at the Urban Institute, who basically does everything for the Tax Policy Center, and Rebecca Sundin here at the Brookings Institution, who put together all the logistics for this afternoon. I can guarantee you that without their tireless work and their patience, none of this would have happened. So thanks to both of you. All right, in terms of the substance, changes in business taxes by other major economies are having important effects on the United States. Everyone knows that our statutory tax rates are much higher than other countries. Everyone knows that most other countries exempt most foreign source income of their multinationals, while the U.S. continues to tax repatriated earnings. In newer developments, many countries are offering new benefits for their multinationals, including patent boxes that allow special tax rates for income for research and innovation. At the same time, the OECD BEPS initiative is intended to limit the ways in which countries can shift their funds out of high-tax countries and into low-tax countries. But American multinationals, many American multinationals, feel that BEPS is aimed at them. In the wake of BEPS, some countries are now enacting new diverted profit taxes that target multinationals. We'll talk about all these issues this afternoon. Basically, we're focusing on what happens in other countries, how that affects American workers, American consumers, American businesses. Our keynote speaker is Bob Stack. We're delighted to have him here. You have a bio in your packet. Bob is the Deputy Assistant Secretary. This is another inhale moment. The Deputy Assistant Secretary for International Tax Affairs in the Office of Tax Policy at the U.S. Department of the Treasury. In that capacity, he's responsible, among other things, for the conduct of legal and economic aspects of tax policy, including having the honor and the burden of representing the United States in bilateral and multilateral interactions with other countries. Before joining the government, Mr. Stack served as head of international tax at the law firm of Ivins, Phillip & Barker. He graduated from Georgetown Law in 1984, where he was editor-in-chief of the Georgetown Law Journal. He also clerked at the Supreme Court. So let me turn it over to Bob. We're delighted to have you here, and we look forward to your comments.
Thank you very much. I just wanted to begin by saying that I have not had the pleasure before today to meet Mr. Lubick, but I would like to say that the outpouring of affection and support that we see here today at the beginning of this ceremony demonstrates, I think, the great affection you've been held in and the fact that you have really been a giant in tax policy, and I want to express my appreciation for that. I fully appreciate how instrumental Don was in creating an Office of Tax Policy at the Treasury with excellence and integrity as the hallmarks of that office, an effort that began with your participation 50 or so years ago, and it's something that, as a current person at the Treasury Department, I wanted to begin my remarks today by expressing my deep appreciation for the contributions you've made and for the way I have benefited from them in ways seen and unseen. So thank you very much. When I began to prepare today's speech, I noted that figuring it was on foreign tax law changes and their impact on U.S. tax policy, I should speak on the topic assigned because that's something I've learned to do. I'm basically a rule follower. And as Bill just mentioned, I checked out the setup on the Brookings website and that Bill just quoted from, and I worried that my speech had been obsoleted as the answers are staring us plainly in the face. Here's what the website says. Changes in the taxation of business income by our major trading partners are creating shockwaves in the United States. Corporate tax rates in other countries have been falling, while the U.S. federal rate has remained at 35% since 1993. The combined state-federal corporate tax rate in the U.S. is now the highest in the OECD. Most other countries exempt most foreign source income of their multinationals from tax, while the U.S. continues to tax repatriated profits. And many other countries are providing new benefits for their multinationals, including patent boxes that allow special tax rates for income from research and innovation. Well, faced with these table-setting observations, how could any self-respecting tax policymaker do otherwise than readily acknowledge that we must join the race to the bottom, dramatically lower our corporate rates, make one with those countries exempting foreign income from further domestic tax, and for good measure throw in a patent or innovation box to further lower the rates of certain taxpayers? What more was there to say? Crestfallen, as I've been allotted 25 minutes to speak, I was fumbling about for what I could possibly add to this debate in which one side seemed to command the unimpeachable intellectual and economic high ground. But as I recall, having been the parent of teenage sons, it hit me. I heard these arguments before. Mom, Dad, everyone else's parents are letting them do such and such. You should too. And failure to acquiesce to whatever it was we were being asked to go along with always was purported to result in the direst consequences. Now, I don't mean to make light of the need for business tax reform. The President has put forth a very robust revenue-neutral business tax reform that the administration is proud of. But I do hope that as the debate unfolds, it will address important questions and be more than a cry to join the race to the bottom. But as important, I want to talk about the international context in which this debate is unfolding and how the context should inform our discussions. On the specifics, the President has insisted on business tax reform that is revenue neutral in the budget window and over the longer term by lowering the rate and broadening the base. This seems reasonable in light of the fact that we face mid to long-term fiscal challenges, and while we agree with the need to bring our statutory rate more in line with the rest of the world, the responsible thing to do will be to make business tax changes taking into account our overall fiscal constraints. Too often, it seems to me, a major impediment to business tax reform arises because there are those who desire revenue-losing business tax reform, without making the case for how we are, as a country, to make the numbers add up to produce fiscally responsible tax policy. This argument for revenue-losing business tax reform is often advanced in urgent tones by those who insist the survival of American business depends on our joining the race to the bottom in corporate tax rates and heaping on other tax breaks on top of that, while ignoring related issues, such as the current ratio of corporate tax to GDP as compared to historic norms, or for that matter, the overall ratio of tax revenues to GDP compared to historic norms. The issue of whether such tax cuts favor capital or labor, or even whether other revenue sources might be available to offset such losses. There are other weedy questions, too. In a territorial or quasi-territorial system, won't there be a need for strong base protection measures? In such a system, should U.S.-parented multinationals be able to enjoy current deductions on interest expense that produces exempt foreign income? And finally, a whole potential topic unto itself, what should our tax rules on inbound investment look like? And how should we ensure a level playing field between companies investing here and those already here and competing with them? All of these questions arise in a politically challenging environment. Marty Sullivan pointed out in Tax Analyst recently, a Gallup poll results indicating that on average over the last decade, 7 out of 10 Americans believed American corporations were not paying their fair share of taxes. Similarly, according to Marty, a 2015 Pew Research poll found that 64% of Americans are bothered a lot by the belief that corporations are not paying their fair share of taxes. And indeed, the business tax reform debate is also taking place in an environment in which writers on tax policy have wondered whether the political steam has been let out of the drive for business tax reform in light of issues that affect everyday Americans, such as minimal average wage growth. I suspect in the panel that follows and in the weeks and months ahead, we'll continue to debate those issues. I would only want to add today that I do not buy into the notion that the U.S. must willy-nilly do what everyone else is doing, because we have our own unique circumstances and fiscal challenges that need to be taken into account as we do the responsible thing for our country. However, as the nation's top tax diplomat, such as it is, I think my value today is really to step back and share a couple of observations about the global tax landscape that we face as we consider international tax reform. And I have 2 observations I'd like to expand on. First, there is an urgent need to create an international tax system that permits greater certainty and stability for investment in the system so that businesses can get back to doing what they do best, running great businesses. Second, I want to elaborate on what I've recently described as a greater need for business involvement in the global tax debate beyond the halls of Congress and the U.S. Treasury. I'd like to begin with some very high-level observations based on over 3 years of representing the United States Treasury Department in all manner of engagement with foreign governments on the subject of taxation, covering the gamut: the G20 OECD Base Erosion and Profit Shifting Project, all manner of engagement on tax issues in the G7, the G8, the G20, asserting U.S. interests in the ongoing state aid investigations by the European Commission, and dealing bilaterally with our important trading partners on a regular basis on all manner of tax issues. Based on my experience, it is clear that the greatest contributors to the unstable tax environment we see in the world have been, one, the ability of U.S. multinationals to dramatically reduce their worldwide effective tax rates, as reported to investors, by permanently investing sums offshore. Two, the so-called mobility of IP income and capital. And three, and these are all related, the role of tax havens, however defined, as players in the international tax system. And let me discuss each in turn. I don't think it's open to debate that the ability of U.S. multinationals to defer income has been a dramatic contributor to global tax instability. I need to point no further than the EU state aid investigations, where it is clear to me at least that if sums that were deferred from U.S. tax had been taxed somewhere, including in the U.S., these cases may never have been brought. But if one needs more proof, look only to the points accentuated in places like the Permanent Subcommittee on Investigation hearings in the U.S. Senate, the Hodge hearings in Public Accounts Committee of the UK Parliament, as well as those held before the EU Parliament and the Australian Senate. These all focus on the very low rates of tax that are achievable, whether abroad or in individual countries, by multinationals, and it is this effect that has caused a great deal of outrage in the international environment. These effective rates can be gleaned from financial statements and other sources, and can be achieved by multinationals through techniques widely available to them. Countries around the world, in times of austerity, pounced on these deferred earnings, which the rest of the world believes will never be taxed in the U.S., and have sought to write the rules in such a way as to take what they view as their fair share of this so-called stateless income. But deferral alone, of course, does not produce low effective rates. The mobility of intellectual property income and capital, that is, the relative ease with which multinationals can move these assets to favorable tax jurisdictions, aided by U.S. cost-sharing and check-the-box rules, has been a major contributor to the ability of MNEs to achieve low effective rates, which has promoted instability in the tax system by feeding the notion that MNEs, and in particular U.S. MNEs, are not paying their fair share. And of course, none of this instability would have been possible without the presence of tax havens, however defined. For present purposes, it should suffice to say that large disparities in income tax rates, whether based purely on the location of the income or by qualifying for a special regime, will inevitably drive behavior to take advantage of the arbitrage possibilities. A goal of the BEPS project, simply put, was to have countries that write the rules write them in such a way as to minimize income shifting into low and no tax jurisdictions, as opposed, for example, for doing such impossible things as seeking convergence on tax rates. Any U.S. international tax reform that does not take a major step towards restoring stability will prove to be a Pyrrhic victory, no matter the rates agreed, the degree of territorial, or the presence or absence of patent boxes. And while the U.S. has worked hard to put the issue of tax certainty on the G20 agenda during China and Germany's presidency, this agenda simply will not succeed if countries perceive that they are getting ripped off under whatever rules we end up with. One aspect of today's topic is, of course, the effect of foreign tax changes on the tax reform debate. But let's look at some foreign tax changes that are flying under the radar and perhaps not adequately appreciated by all policymakers. I would submit that many, if not all of these rules I'm about to talk about, are motivated by a concern that the rules as they exist today let companies achieve unacceptably low foreign effective rates, and the countries are fighting back. Let's consider the UK diverted profits tax and its Australian equivalent. But let's also consider jurisdictions that are limiting deductions on royalties and other payments if those payments are going to low-tax jurisdiction. These sorts of rules are squarely the efforts of source countries to take aim at companies that shift income into lower jurisdictions, often by imposing taxes that would likely be creditable for U.S. tax purposes. In the absence of fixes to the international system, I think we are closer to the beginning of this trend than to the end. And these changes go beyond limitations on deductions for payments to low-tax jurisdictions. Consider the difficulties multinationals have in deducting management and service fees paid among affiliates all over the world, regardless of the destination of those fees, as well as the drive in some countries to find a permanent establishment and then go search the globe for the IP income that could be potentially sucked into that jurisdiction once the PE is found. And finally, for good measure, consider the recently proposed 6% equalization levy that in India with respect to outbound payments for digital advertising services. The levy is a supposed non-income tax, withholding tax, imposed on all payments made to those outside India for advertising services in India. What's remarkable here is India decided to leapfrog beyond income tax and its related permanent establishment treaty rules to impose tax on income often destined to a tax advantage location. There is no movement among the countries in the OECD to examine any of these various proposals that may be or considered to be beyond BEPS. If U.S. international tax reform perpetuates this instability, shame on us. We will see more of it and more time and money spent by our multinationals combating an increasing flow of inconsistent results around the world, as well as the resulting disputes. And if the U.S. multinational community continues to see it as in their best interest to perpetuate a system built on tax arbitrage and highly engineered tax planning, shame on them. You are signing up for and bringing on more of the very instability you loathe and that impedes your business. The President's global minimum tax proposal may well provide a strong antidote to such perceptions around the world. First, our business reform permits tax-free repatriation of amounts earned in countries taxed at rates above the global minimum rate, wherever it's ultimately set, thus permitting our multinationals to compete on a level playing field in virtually all of the major markets around the world and repatriate the profits without additional U.S. tax. But the global minimum tax plan also takes the benefit out of shifting income into low and no tax jurisdictions by requiring that the multinational pay to the U.S. the difference between the tax haven rate and the U.S. rate. The global minimum tax concept has an added benefit as well, and that is protecting developing and low-income tax countries from foreign-to-foreign shifting so they can mobilize the necessary resources to grow their economies. While it is true that concepts such as minimum taxes and controlled foreign corporation rules are most effective if most countries go along in imposing them, and so far the UK has been a staunch opponent of tightening these rules, I believe it is also true that the pressure will continue to build in the international community for the traditional residence countries to take into account the spillover onto poorer countries of tax policies that encourage foreign-to-foreign stripping. Stay tuned. Indeed, at a recent IMF symposium, the minimum tax was identified as something that could be of great help to developing countries by the mere expedient of disincentivizing foreign-to-foreign shifting by multinationals resident elsewhere. This last point, this discussion of what's happening in the debate with developing countries and the need to help them protect their tax base, shifts me nicely into my final observation. The need for greater involvement by the multinational community in the international tax debate. Let me begin by making two rather obvious points. First, the BEPS project plainly took the business community by surprise, particularly in its effectiveness of changing the rules of the road and the environment in which these companies operate. Second, whatever the EU does with respect to requiring companies to report public country-by-country tax data and revenue data, we would all have to admit that transparency issues, spurred on in part by the Panama Papers, have shot to the top of the global agenda. And no amount of lobbying at Treasury or on Capitol Hill will stop global pressure for more transparency. Might the arm's length standard be served up next? It's broadly suspect. And Lee Shepard, one of our own reporters in yesterday's tax analyst report, had some choice things to say about that. And if you watch how quickly country by country went as an idea among poor countries in developing spaces to being a headline story in Europe, potentially making it public, ask yourself, how quickly might the arm's length standard and country by country be put on the chopping block? And back to transfer pricing, the effort we had in the BEPS process to take a paper that seemed to us to write the arm's length standard out of the OECD rules, to bring it back to something that seemed more familiar, at least to US tax practitioners, was a very heavy lift. The US has been a staunch defender of the arm's length standard and will continue to be for reasons I've elaborated on elsewhere, but we don't control the global agenda. So what do I mean by greater M&E involvement? Well, first, I don't advocate greater M&E involvement as a means of taking sides, as in, I really need their help, although sometimes I do. It just occurs to me from my perch that when I meet with governments, as I regularly do, and as I attend global tax events, with themes often pushed by NGOs are dominating, that if the M&E community has a compelling perspective on these global tax issues that should be appreciated by policymakers around the world, it is not being made effectively. But that leads me to my second point. The M&E perspective needs to evolve way beyond we pay all the taxes we owe to something more, shall I say, fulsome, to combat the pervasive perception that multinationals do not pay their fair share, that transfer pricing is some sort of illicit practice, that blatant profit shifting is rampant, and that therefore those nations need aggressive national action to rein those multinationals in. How the multinationals get engaged and participate fully in this debate, I leave to them. But I don't think it's a task that can be ignored. Part of the discussion relates to creating conditions that are supportive of foreign direct investments in countries around the world. And that relates back to the fact that at the G20, we're going to begin to look at the relationship between tax certainty and creating environments to increase foreign direct investments in countries around the world. And that's a good thing. And by investment, we need to teach those countries that investment and growth mean more than attaining the investment needed merely to serve their large markets. Part of this discussion relates to the need for more data to analyze taxes paid by multinationals in the jurisdictions around the world and to focus the international tax debate more around a data-driven search for best policies and practices, including policies and practice that encourage investment, and much less on sensational and politically palatable anecdotes. Mindy Hertzfeld, in a recent thoughtful piece in Tax Analyst, made reference to, quote, the bubbles in the tax world where people surround themselves with like-minded thinkers and fail to see the perspectives of others outside it. To give you an appreciation of this phenomenon from where I sit, on one day I might be attending a U.S. international conference, as I did the end of last week, in which we parse in excruciating detail the transfer pricing equivalence of how many angels can dance on the head of a pin. From my perspective, this is not about picking sides, but rather the discussion needs to be fully engaged by all stakeholders so we can move forward and promote growth and create more favorable conditions for investment around the world, including in the developing world. NGOs and representatives of the business community should be at the same conferences, listening to and challenging each other's facts, arguments, policy proposals, and visions for an international tax structure that works for everyone. I made these points at a recent speech, and afterwards someone in the audience came up to me and said that he didn't think moral suasion was going to be effective and that the multinational community will always be looking out for the bottom line. And I was somewhat crestfallen because it drove home to me how ineffective I had been in trying to make my point. Because I think I am making a point based on the bottom line and not moral suasion. I think I'm making a point aimed at boardrooms and not technical tax people. After all, it's the boardrooms that are supposed to care about the long-term consequences of actions and the reputational effect on the firm. Aggressive tax planning and all the related elements that I've talked about has already imposed a great reputational cost on some firms, and the future trend is clear. I am suggesting that at the end of the day, companies and countries will both prosper in an international tax system that minimizes distortions built around tax benefits that can be achieved through a combination of the mobility of IP income and capital and games played through tax havens with a boost from U.S. cost-sharing regulations and the check-the-box rules. Policymakers should be exploring how to build those structures, and all stakeholders, including MNEs and NGOs, should consider whether they share these perspectives, and if so, how to participate together effectively with government representatives to build them. We are long past the days, if they ever existed, when Congress and the executive branch were the only players of importance with respect to U.S. international tax policy. Globalization and the emerging political structures that support it have brought these issues to the world stage, and the actions of each country has effects beyond its borders that must be taken into account as we build an international tax policy for the years ahead. And the actions taken outside our borders, likewise, can have a profound impact on our taxpayers and the policy and the wisdom of policies we set, and we're living through that. This is all hard work in a challenging environment, and I will be the first to admit that other countries sometimes do little more than to seek their own national advantage instead of supporting principled rules. But we owe it to average Americans, as well as our successful companies, that we stay at it so we can give the world a little extra scoot in the right direction during the time we are privileged to be engaged in helping to form U.S. international tax policy. Thank you very much. Okay.
Maybe we can both stand here.
Oh, we're going to both stand here.
Okay, now.
This is the moderated discussion.
This is the moderated discussion. It will be very brief. So I found your speech very interesting, and it seems to raise a question about whether we should think more about the general values or ethical climate in which we all approach these issues. And I was wondering what things the government could do to kind of encourage more of that, both on multinationals and with respect to other governments' policies.
Well, actually, I'm afraid I'm not going to rise to that bait, because as a technical tax guy, I've had trouble distinguishing my extra mortgage deduction when I buy a really big house from the double dummy Irish. And if anyone else can draw the line where you've crossed from morality to immorality, we can have a debate later about it, but I can't do it. I think it is about making policies and rules that we all agree to live by, but I don't think it's about naming and shaming.
So I guess we'll have a couple of minutes for questions from the audience. Anyone have any questions?
Way in the back, Jeff Vanderwall.
Okay, please.
Yeah. It seems that with the new sort of more inclusive framework that the OECD has announced for the BEPS implementation, the transfer pricing follow-up work on profit split and related things like attribution of profits to a PE, may sort of be the acid test of the ability to sort of reach any kind of consensus with this larger group. Can you comment on that?
Yeah, sure. I actually, from my experience, I don't expect that expanding the group actually will expand the number of very engaged players in very technical transfer pricing issues, number one. It's just not been my experience that, you know, we found it difficult to keep up with the flow of OECD paper, and we're one of the biggest countries in the world. So I'm not too worried about that. And second, in that follow-up work, look, like all in BEPS, you know, we're a player. It's a consensus process. You know, I think we'll have a strong influence in the work as it goes forward. So I'm not terribly concerned about the effects of that. I do think, though, to return to a theme that I was trying to hit on, is I think U.S. policymakers completely ignore at their peril what's happening in developing countries, low-income countries on the global political stage, and that a lot of that bubbles up into things you see every day. Some people, you know, in the tax world think I do this as almost like an avocation, it's a nice thing that he cares about these things. But in fact, if you're not paying attention there, you're missing a ship that can sail, you know, 2 years before you realize it's sailed. So for U.S. policy, I think it's critical. Mindy.
Do you think there's a legitimate role for international tax competition?
Well, you know, whether I think there's a legitimate role for it or not, it's going to exist, right? I mean, we're never going to drive out the arbitrage that comes from differential rates, because that's kind of one of the rules of the road. People can have their own rates, sovereignty. Ireland has a 12.5. So, and I think it would be naive to think we're going to build a system that gets away from arbitrage. But I think when you get to highly structured transactions through what we would all recognize as tax havens, I think you're in a different place that you probably can do a better job at policing. And we should. And U.S. companies should welcome it.
Okay, well,
Oh, John.
one more.
Is the UK a tax haven?
I think it wants to be.
Is it?
But I think it's conflicted, actually. As a source country, we're seeing that it's going to be very protective of anyone using the UK market, and they're going to limit deductions. They're going to watch tax havens. A lot of this is going on right now in the hybrid work. And if you're in that, as Mike Williams has said to me, we'll have a 17% rate, but you're going to pay 17%. And so they're going to be very aggressive in protecting their market as a source country. As a country that wants to be the home of headquarter companies and have weak CFC rules and get the spillovers of the benefits of having such and such headquarters in London, they're going to want to do that too. And then they're going to fight to have weak CFC rules so companies will find it an attractive place to be. So I think they're kind of hybrid. Yeah, the patent box is, I think, a part of what will be driving it. But in my discussions, for example, with some countries, they have viewed that as something that will be beneficial to their mid-sized companies, because they're not convinced themselves that the world's going to rush their researchers over into their patent box. Remember, if you're getting 10% income on your patent income, you're getting a 10% deduction. And you got to figure out a way, you know, the game here is to get the high deduction and the low amount of income. And it's not clear to me you do that by doing all your research offshore and moving your researchers. Yeah. Last question.
You talked about, you know, UK headquarters companies, but you also referred to US companies. I mean, isn't one of the issues that we're facing here that companies don't have natural nationalities? And, you know, how, as a policymaker, do you address that other than, you know, fighting a rearguard action with anti-inversion proposals?
So great question. So, you know, when I first got my job, I quickly realized, and I consulted with some of the really bright academics, some of whom are here, that there's all sorts of interesting ideas about there, like sales-based income tax, blah, blah, blah. None of them are ready for prime time, and none of them are coming before me on my watch, or before Congress for that matter. So we have the system we have. You're absolutely right that mobility of headquarters, mobility of these items makes the current residence-based system fragile, no question. But as policymakers, you know, we get to play the hand we're dealt, and that's the hand we have for now, and we'll play it best we can. Thank you very much.